Hello, everybody. Welcome to the September 2023 edition of the Equity Market Call. I'm Tori, the CEO of Equity, and I have with me my co-founder and our Chief Investment Officer, Itai. We're going to be covering a lot of important information for investors at this juncture in the market cycle. We truly believe that we're at an interesting crossroads. And to tell you a little bit more about that, Itai, why don't you tell us what you got in store for us for this month's call?
Yeah, thanks, Tori. Happy to. It's really a follow-up to a lot of the things we've talked about over the last few market calls, really since July, that we said the probability of a hard landing and massively underpriced in markets. So far we've been right about that call. But also I want to expand about why it doesn't just matter for the next few weeks, the next few months, but really the next few years and potentially the next decade. I don't want to sound too dramatic, but I think being macro aware right now is one of the most important things you can do, as we're seeing a lot of similarities both in the 1970s and really some of these policies that led us here and how they're going to transpire into the future. I think this is going to just be a really interesting time, not just intellectually, but also for your portfolio.
Let's dive into it then. Let's talk about the calm before the storm.
Right, so we're seeing a lot of the data starting to confirm that hard landing narrative we've been talking about. I know the media keeps talking about a soft landing, maybe less so over the last few weeks. But we are starting to see a lot of signs pointing into a hard landing, possibly into 2024. So first off, inflation. The Fed has recently, in the last FOMC meeting, despite not raising interest rates, they have reiterated this higher for longer narrative and inflation being a problem. What they're talking about is right in front of you here. You're seeing an inflation chart over the last decade. Following the post-COVID inflation spike, what we're seeing is that inflation possibly is re-accelerating. We might have troughed out around June, July period, and the last two CPI readings have been actually higher, led by energy prices. And what we're also seeing that I think is a problematic thing is that core services inflation has barely budged down from its highs. So again, what we've seen is the more volatile energy, food, and core goods starting to drop, but services inflation has remained elevated, and now it appears that energy and other types of commodities are re-accelerating. I can tell you orange juice, for example, and live cattle futures all made fresh new all-time highs just in the last few days.
Yeah, and we've talked about this previously, but the services inflation is really the stickiest form of inflation. And so this isn't a surprise. It's something we've been talking about for a while, but you're really starting to see the trend reveal itself as we move away from the trough in June.
That's correct. And of course, the biggest worry is this going to be like the 1970s, where services remain sticky for over a decade?
Well, maybe something that can inform that is in the jobs data. What are you seeing there?
We've heard all this talk about, well, but the job numbers are still very strong. We're going to have the soft landing most likely because employment is still very strong. But we are starting to see a real deterioration in the jobs data. We talked about it again in the last market call. But one of the things that I found was really interesting is the numbers come out on the first Friday of every month, and then the last two numbers are getting revised. And every single report this year has actually been revised down, and in some cases meaningfully down. I actually have never seen that. So something is going on here where they want the headline numbers to look a little bit better, but then when nobody's looking at the months that came before, they're starting to revise them down. So just an interesting trend to notice.
Well, the question is it a coincidence that we're seeing this as we're fast approaching an election year? It's not for us to say, but it's interesting nonetheless. When it comes to job openings, there's been some pretty sharp trends there.
Yeah, this one is a leading indicator to the jobs number as a whole. This starts here in 2000, the JOLTS, the total amount of job opening, and you can see that it does have a strong correlation to the wage growth as well. So as open jobs diminish, wages actually drop as well. However, the Fed wants this, right? Because they want to cool down inflation, particularly services inflation. But I always like to say, be careful what you wish for, because if you cool it a little bit too much, and profits start diminishing, then you typically fall into a recession. Again, it's not rocket science. The cost of stopping inflation historically has always been a recession. And I don't believe that this time is going to be any different.
Yeah, and what's strange is the stock market seems to be reacting very differently to this news in terms of weakness in the labor market. Why is that?
Yeah, so here's one of the most interesting charts starting here 2015. You can see that the total amount of job opening in the economy has an incredibly strong correlation with the stock market. And then what we're seeing in early 2023 is this generative AI breakout, which has broken this historical correlation with the job opening. And again, I don't necessarily think that's going to maintain itself for a while. We made a lot of comments talking about this. And for example, I just looked at the numbers today, and the S&P 493, that's how I call it now, is actually flat for the year, where the Mag 7 are still up almost 50%, I believe. And it's really those 7 companies that have led the S&P 500 higher. So if you take them out, the total stock market will be a lot closer to the number of job opening. And therefore, if you believe that the job openings is going to continue to decelerate, as it likely will, as the economy cools down, then that should have negative impact to the stock market in the long term. But again, I reiterate, in the long term. The short term is something very different.
Right. And so, okay, if we're seeing this trend, dropping job openings, and another leading indicator you talk about a lot are retail sales. What would that seem to indicate, regardless of what the stock market is showing right now?
Right. So the consumer is the most important part of the economy to look at. And the reason is the US economy is roughly 70% consumption, and corporate profits that are responsible for the stock market and many other sectors of the economy, including job creation, even the real estate markets, et cetera, have to do with retail sales, because the more people buy, the more profits companies make typically, right? And what we're seeing is that retail sales, ex auto and gas, which are more volatile, are really cooling down towards the zero line. And really that's when the economy reaches stall speed. And therefore it's really important to look at the health of the consumer.
Where's that money coming from to keep the spending, just barely above the zero line?
Max out your credit card. America.
It's the American way.
It's the American way. So this is really interesting, right? Because we see the consumer credit outstanding on one chart, and then we're seeing the total personal interest payments. I have never seen interest payments rising this quickly ever. And a lot of it has to do with really maxing out the credit cards, but also interest rates rising rapidly. And this is really, really problematic, because you can see we went from 250 billion in interest payment to 500 billion in 2 years, double, right? And what you see is that it's unsustainable in the past, both in 2007, 2008, 2000, and even pre-COVID. Once we see that number starting to drop, meaning that interest payments actually drop because people are most likely defaulting on their credit cards and they can't pay anymore. And in COVID case, it was actually because they got a bunch of money from the government and they couldn't spend it because the economy was shut down. So they actually paid down their credit card balances. But typically when that happens, the economy falls into recession right around the time of the deleveraging, which hasn't happened yet, but it looks to be in an unsustainable situation right now, because once the deleveraging starts happening, that really cools the economy. And talk about the health of the consumer itself. So what you're seeing in this chart is the total savings rate, which is very, very important in order to understand, can the consumers keep it up or not. This starts here in 2016. You can see that the personal saving rate is just below 10%. And then COVID happens and that number goes to 40%. You see the first stimulus check in that first bump there. Kind of looks like a VIX chart. And then you get the second stimulus package, and then you get the second one. And what you're seeing in the light yellow, we've narrated it ourselves when we tried to figure out how much excess saving was actually there. You can see the consumer actually built a lot of excess saving into 2021, but then two things have happened this year. First is the personal saving rate, because of inflation today, is actually lower than it was pre-pandemic. People were saving roughly 8% of their paycheck. Now it's actually less. But also the excess saving from the pandemic is not only gone, but turned negative.
So is it safe to say that the consumer is starting to teeter on the edge of exhaustion?
And you're seeing that already in retail sales that have massively slowed down. Now, again, the market has liked this because the Fed has iterated that that's what they want to see to bring inflation down, which historically it should bring inflation down. But the price of that is likely going to be a recession.
Right, and we're seeing it elsewhere.
That's correct. So we're seeing that interest payment tick up, and now we're starting to see delinquency rates pick up, which we've seen in 2023. They actually troughed out in 2022, and you can see how that looked like in 2000, 2007. Now, it's interesting that the 2009 to 2020 period had very low delinquency rate. I mean, it was actually high in 2010, then it started dropping, but it stayed abnormally low between 2014 to 2020 based on historical trends. And why is that? We were in a very, very historically weird period. I mean, weird is a professional word. Why? It was the only period in history where rates were zero.
Yeah, so it's pretty easy to keep up with payments when rates are so low.
That's right. But if you look at it at a 100-year time horizon, it's an historical abbreviation. People now, I believe, are expecting rates to come down to those levels, and many markets are pricing based on that. But if you're looking at the very long-term historical period, it's actually the zero interest rate that was the abbreviation, not 5% rates or not 4% rates. But I'm not actually sure that's sustainable in the long run. So we'll talk about that in a few slides. Again, business bankruptcies as well are starting to approach pandemic levels. So businesses are now struggling as rates have gone up even mildly. And you can see that with job openings starting to falter. So businesses are struggling. The first thing they do, they cut their open job positions. Not something we've seen in the past.
So if we're working our way, there's the individual. We see where the individual stands with their savings, interest payments creeping up, savings exhausted. Now you're starting to see it reflected in business bankruptcies. So, the small businesses. And I guess then the last logical question is, what are you seeing in terms of corporate profit? So more at the high end of the balance sheet.
Yeah, so this is an idea of corporate profits as a percentage. So this goes back to the post-war period, 1947, and you can see the corporate profit as a percentage are historically very, very high. And a lot of it was actually fueled by very low rates. So in the last market call, we talked about how large corporations were able to refinance debt at very low levels, and using those proceeds to really pay down their rate. But we're going to have a wave of refinancing in 2024, 2025. If rates do stay higher for longer, it's going to have a major impact on the bottom line. Corporate margin, corporate profits tie down to earnings, earnings tie down to stock prices. And what we really see is that the kind of low interest rate period, with that exception of the global financial crisis, had a relatively higher than average corporate profit. So if you're going back to the old normal of the post-war through the 2000s, historically speaking, corporate profits were substantially lower, almost cut in half than where they are today. That could have a pretty significant impact on long-term valuations, if that really is the environment we're going to go back to.
Interesting. Okay, so your theory then is that there's the zero interest rate environment is really what led to that increase in corporate profits, and that actually that's not necessarily the natural state of things, but that corporate profits more likely should return to trend, quote unquote, as we align or realign interest rates. Am I understanding that right?
If interest rates actually go back down, stay elevated right for a long period of time, that's a very, very big if.
Well, let's talk about that. So obviously Jay Powell came out and he made representations that, they will stay higher for longer. What's the dot plot telling us?
Yeah, so the dot plot is saying that 2024, they're expecting rates to be 5%, more or less for the whole year. And then long term, 2025 is a wide variety of opinions, but nobody's talking about, 2%, et cetera. And then the long term, between 2 to 3%. So the Fed is projecting kind of the old normal eventually, where rates are between 2 to 3%. But despite having inflation rates, at least on paper, lower than the Fed fund rate, we actually have a 2% real yield world today, where you're actually getting 2% of real money on treasury investment, short-term treasury investment. So the Fed says we're committed, higher for longer. We're worried inflation is going to get entrenched if we do not. And hell or high water, that's what we're going to do. I absolutely do not believe them, but that's what they're saying right now.
Yeah, the market seems to agree with you and not necessarily them.
So partially. Actually, that's not. The market has actually started capitulating on that. with the bond market totally collapsing over the last couple of weeks. So the market has started capitulating on the Fed stance, which we've seen that in prior cycles as well, right before a hard landing was actually happening. So in a way, it's a very interesting reflexive behavior where the Fed says higher for longer, the market doesn't believe the Fed has to keep saying higher for longer. Eventually, the market believes the Fed, it crashes the economy, actually leading to rate cuts.
Which is actually a good segue then to the next slide, which tells us that the market is in fact bracing for a pretty serious economic contraction.
Yeah, so when you're looking at the Fed funds futures market, what we're looking here is that actually the market did take down some of the rate cuts into 2024 off the table. 2 rate cuts were actually taking off, so the market's starting to believe the Fed in a way, and that's causing severe tightening on the real economy because the long-term rates are the ones that are really moving up. I'll talk about that in a second. But the market is no longer, no one's pricing in, the probability of another rate hike in 2023 is very, very low, and it's most likely that the Fed is in fact done for the year or in this cycle. So just like we said in the last market call, I continue to believe the Fed is done. We're actually at the terminal rate. The question now is how quickly do we come down off of it?
Right, and I guess only time will tell. And I mean, what are the things that could factor into their decision in terms of how rapidly they would reduce rates, right?
I'm going to go here on a little bit of a bold prediction and say if you're looking at the US government finances, I actually don't believe that they are able to sustain higher for longer more than a certain amount of time. We'll talk about that in a second.
Yeah, well, maybe we should dive into that then. So let's talk about this, the end of ample federal funding. What do you think is what's behind that?
Yeah, so we live in an era of, lack of fiscal discipline, to say the least, right? We have seen a long period of zero interest rates, which resulted in ballooning debts and deficits. But then post-COVID, the governments have seen 2008, 2009 was fine as far as expanding debt deficit, that they were able to bail out the world and print money and really not result in a lot of inflation. So then they basically really accelerated that post-COVID. There was a lot of talk on modern monetary theory, how creating massive deficits don't really matter, and how it will never really result in real world inflation. Turned out you print money, you get inflation. Who would have figured? So now we're in a world that is just flooded with debt on a mass scale, and that debt is not unique to governments, corporations, individuals. When incentives to borrow are so high because rates were so low for such a long period of time, rational players are just going to lever up because that's the rational thing to do. And that's really one of the key issues of where we are today and how a combination of massive debt loads and rising interest rates is likely not going to be a good combination.
Yeah, we're starting to see the ramifications of such a rapid hiking cycle when, to your point, cheap debt has essentially found its way into every corner.
But we haven't really felt that yet because most people had fixed rate debt, right? So how many people are actually out there trying to buy a home right now? Effectively none. Housing market is frozen. So if you were able to lock in debt during the period of low interest rates, you're okay. But the longer this continues, the more of the impact you're going to feel and the more difficult it's going to become, starting really in October, where we're starting to see some real problems. So, so first off, we have the government shutdown, which is very, very likely. I think probability markets are putting it at about 70%. Now, again, I don't necessarily think it's going to shut down for months. History shows this typically gets resolved in a few weeks, but the longer it lasts, obviously, the more damaging it is to the economy. I think a much bigger deal is going to be the student loan repayment resumption, which post-COVID, no student loans were actually getting paid up until October 2023. It's hard to believe, but that resumption is going to be very substantial, especially for consumer spending. We just mentioned how important the consumer is and how close it is to actually the zero line. $1.6 trillion of debt between 44 million borrowers is a very, very large number. And child care stabilization program, again, a hit on consumer spending, but not nearly as large.
Yeah, this feels like a really substantial change given where household balance sheets are today. They're already stretched quite thin due to inflation hitting the bottom line, and groceries or services in the form of babysitters and everything related to keeping the day-to-day going. And then to have these additional expenses hit at the same time, it seems like a lot. So let's talk a little bit more about the government shutdown. So you said you're not sure how long that'll last, but
Well,
how
the
wide is the
impact is
impact?
somewhat wide, but it's not so dissimilar from some of the prior government shutdowns we've seen. There are a few over the last few years. But again, the key part is that it could create a temporary hit into consumer spending, and the longer it lasts, the more vulnerable things could become. But again, I'm not incredibly bearish about that, just because historically government shutdown didn't necessarily result in a bad outcome per se, but it's the combination of that and so many other factors that is really hitting consumer spending right now. The key issues here that we're in a gridlock, and that depends on, do you believe that our incredibly partisan government can reach some levels of compromise, which seem to be less and less likely as things get more and more radical and extreme as years progress, unfortunately, as it is. And really the difference here is Republicans want a resumption of the border wall. They want spending caps. They want cuts for domestic agencies, and the Democrats want more funding for Ukraine and disaster relief, as well as keeping spending at current
So a lot
levels.
of hardline issues, but we'll see. Usually, when the political pressure gets great enough, they're able to find some sort of compromise.
History shows that they always find, the kind of 11-hour
Yeah.
compromise type of thing, and I don't believe
Yeah.
this is
Well, I
going to
mean,
be
for the
easy.
sake of the 600,000 jobs, I definitely hope so.
But that doesn't actually, solve this issue where we are living in an era of extreme fiscal excess and spending. Just to put this in perspective, we are now spending around 9% of GDP, which is not seen outside of world wars and pandemics, just in a normal year, right? So you can see 2020 and 2021 pandemic years, you can see the size of the deficit in 2.5 to 3 trillion, but even 2022 was elevated. 2019 is elevated, but look where 2023 is. It's somewhere in the middle, and it's just there's no reason to reach these huge levels of deficit when, quote, the economy is fine, and that is going to create an enormous issue for the United States government and really global governments in the future. So this is a snapshot of the deficit today. So you can see 4 trillion brought in, 5.5 trillion taken out. And this is actually lagging data as of August. I'll show you what the actual interest payment is already. And trivia, that's not 630 billion. It's approaching very rapidly. It's already above health, and it's just below Social Security. It's the second largest line item for the U.S. government. So, this is when people say, okay, higher for longer, can we really sustain that? Well, if half your tax dollars go to just paying the interest payment, can the Fed actually hold higher for longer or not is the key question. So we're coming into some very, very tough decisions that both the Fed and policymakers are going to have to do, as this situation is really borderline unsustainable. So here it is, 970 trillion, about to surpass $1 trillion, Social Security 1.2. So again, second largest line item in the United States budget, just paying interest on the debt we already
Yeah,
owe.
970 billion does not seem sustainable, just given where the balance sheet is.
And if you go back to that prior chart, that's more than defense
Yeah.
spending, including Ukraine. It's more than all health spending, more than Medicare, income security. Forget about all the small line items like transportation and better. Like imagine just if you invest in the crumbling infrastructure anywhere near what you're paying for the interest payments. And now we're in a situation that the Treasury has to issue an enormous amount of new bills and Treasury issuance just to keep paying the same, just to maintain the budget. So, we're borrowing in order to pay the current interest payments. If you were an individual, I would not recommend that.
Right. No, and when you look at this chart, I mean, it seems like out of nowhere we went parabolic. I mean, obviously we know the pandemic was a large driver, but to your point, there's no justification for the continued excess spending. And the question I have is like, why hasn't there been greater public outcry over this because we're putting ourselves in a situation where there is no return.
Well, one of the big reasons here is that we are in the midst of the fastest Fed tightening cycle in decades as a result of inflation. So while inflation was low, sure, you can keep borrowing and borrowing and borrowing like there's no tomorrow, but that's what the government has done. So the government itself has been conditioned by decades of low interest rates. And guess what? When rates go up from 0 to 550 basis points, that has massive implications on the current debt. And to make things worse, 30% of US debt actually expires next year and has to get refinanced into all these higher rates.
Well, and so to draw parallels, right? So we're talking about how, the US government is having to deal with the repercussions of its actions in terms of its borrowing and excess borrowing. You spoke earlier about student loans. It seems like, while we've kicked the can on that a little bit, that is a massive expense for well over 10% of Americans that is about to come back. And it doesn't just impact one generation. This is truly like a multi-generational problem. What are you thinking in that regard?
Right. So one of the surveys I read said that they're expecting those student loan payments to add another $400 of expense to an already dwindling average household, and the majority of that is with the peak quote consumer, which is that demographic 35 to 49, and that has the most impact on retail spending. So again, it is another point that just pointing out that we're likely heading into a recession.
Yeah, it's a bad sign when the majority of borrowers are really concerned about their ability. This was some interesting data you were sharing earlier in the week.
Yeah, what really took me by surprise is that even those that make over $100,000 a year are having some serious issues making those payments. So clearly those with less than 50K are saying, you know what, half of those people are just, I'm just not going to pay it and we'll see what happens. But even 14% of those that make over 100K are saying that. And a lot of them are saying, look, we're going to have to make cuts, 43%, 41% of the other group. So, I mean, there's just no way it's not going to have a very, very negative impact on retail sales, which translates to corporate margins, translates to more job losses, and just causes the economy to contract even further. I mean, this is the equivalent of, the opposite of fiscal stimulus, right? If basically giving you the ability not to pay it, put that money into the economy, created more stimulus. This is the equivalent of fiscal QT, right? Quantitative tightening.
Yeah, and it's hitting. It's hitting everybody, right? So we see that government's going to have a hard time keeping rates high, but it's going to be households are going to have a hard time keeping up the spending. They've exhausted savings. It's all going on credit cards. But again, that variable interest rate debt has also been rising. So it seems like in a lot of areas, something has to give. And I know that the next sort of broad category you want to touch on is it seems like there's a lot of other indicators of economic fragility that you've been seeing. Tell me a little bit more about that.
Yeah, absolutely. We'll analyze them kind of one over the other, but in combination, it is a perfect storm. We brought on in the past leading economic indicators. But one of the things that I'm seeing that really worries me is the prospect of stagflation. So we've been talking a lot about, okay, we're going to get this recession, inflation's going to come down, hopefully. The Fed will be able to lower rates, as they always do, and put a spark of life back into the economy, and then we have a new cycle without that inflationary spiral. But what is very, very worrisome is that we are seeing signs of this 1970s type stagflationary era where we could be in a really problematic situation if we do fall into a recession. Economic growth slows down, but inflation does remain sticky. One of the symptoms of the 1970s was that strikes were just continuous and all the time. Unionization was rising, and it makes sense, right? People were seeing their purchasing power dwindle with inflation, and they were saying enough, and we need to get paid more. So they're striking and asking for more pay. That was very frequent in the 1970s, the era of stagflation. But then what's interesting this year is that we're starting to see strikes across the board. The famous one, the actors one. We're now seeing the automaker union. We're seeing a variety of others joining these types of strikes, asking for more pay. And the thing about it is it's a double-edged sword because as wages rise, that's one of the key contributors to core inflation. So if these strikes continue and wages do rise, it actually increases the likelihood of having more stagflation rather than just a generic recession. Because if we do go into a stagflationary era and we go into recession and the Fed is unable to lower interest rates too much, that can cause even more severe economic pain.
Well, and how does this also translate through to GDP growth?
Right. So just the strikes on their own create more negative economic growth, clearly, as you're having supply chain issues, but it also increases inflation because you just have less supply of whatever. Even if demand goes down and you have no supply, you're still having increasing prices, which is one of the factors of the 1970s. Lots of strikes, lots of supply chain issues, lots of continuous inflation, but also economic slowdown and just less demand. And that is something that I'm worried about. We even see that in the housing market as well, with prices staying elevated just because there is no supply.
Right, and so we're seeing this hit across a wide variety of the economy. And I mean, one of the indicators that you brought up on our last call was this gap between GDP and GDI. Can you explain that again? I mean, has
Yeah,
that continued, that
so
trend?
the difference between gross domestic income, which is the income brought in the country, and then the gross domestic product is now the widest it's been since the global financial crisis. So you can see, go back to 2007, 2008, GDP was staying elevated, but then GDI went negative, and that was a sign of a recession. And when you look back into this indicator, I've not seen a period of time where GDI actually tracks negative, and GDP does not follow, and it leads into a recession. So I think we're seeing a lot of the lag effects of ample government intervention and fiscal stimulus, but at the same time, GDI has already turned negative. It's very likely that GDP will fall in the coming quarters as it becomes apparent that we're most likely in for a hard landing.
So we're seeing it in the labor market in the form of strikes. You're seeing fragility and how that works its way into GDP, as well as the leading indicator here of GDI versus GDP. Of course, then I think a lot of people, they start to ask also about housing, right? Well, what about the housing market?
Housing market is one of the key indicators for the economy as a whole, because as people buy a lot of houses, as the housing market booms, the economy booms. Because if you think about it, it creates so many jobs, right? You need to buy furniture, and you're moving to the suburbs, and then you buy a car, and then it creates all this consumption, and it's a very good sign of a healthy economy. But what we're seeing now is the impact of the fastest Fed tightening cycle in decades. I believe mortgage rates for a 30-year fix are over 8%, which means that a $500,000 house, now you need almost double the monthly payment as you did just a year to a year and a half ago. And then it's just stuck, right? Because if you have a 3% mortgage, there's no way you're going to sell and trade for an 8% mortgage. So you're just staying put. And people are going to continue to do that as long as they can, but at the same time, very few people can afford to buy. And the majority of those that do are just going to want to buy cash if they can afford it, because they don't want to pay 8 or 9% rate. It just doesn't make sense. So the ending result is that we're seeing the least amount, actually it's the lowest affordability in the history of the survey. So even going to 2006, 2007, the peak of the housing bubble, houses are now less affordable than they were back then. It's the least affordable housing market in history. And at the same time, there is no supply. So let me make this very clear. This is the biggest difference between now and the housing bubble. If you go back to 2006-07, there was a ton of supply. So it's very clear it's a bubble because there's no affordability, and then there's a ton of supply. So something's got to give, and prices crash. However, now it's very different because there is no supply. Everyone's stuck in and dug in. And how does that resolve? It's very unclear, because I think, again, it's more 1970s-esque, where this could lead to stagflationary pressure, where housing prices, as they should come down, actually do not come down because so many people are stuck in a 30-year fix as long as they can keep their jobs, right? If there are massive layoffs and millions of people lose jobs, then that can change as people are forced to sell. But even then, I think people are going to rent to roommates, are going to try to do anything they can to keep that low rate mortgage in place as long as they possibly can.
Right. So it seems like you're seeing a lot of these stagflationary indicators everywhere. If you wanted to continue, researching this, like, where are the other places you're looking to validate it?
Right. So it's really a combination of everywhere where demand is faltering, but then supply is falling faster. So that creates that type of situation, because you have contraction in the economic environment and in the spending power, but then at the same time, prices do not fall or even rise. And that's really a combination of things. So in this housing market example, you can see why that is. And again, a lot of it is supply side shock, wage pressures, etc. So again, somewhat of similarities to the 1970s. There are also a lot of differences. Clearly, demographics are very different, and other things that are more structurally non-stagflationary. But as of right now, things are looking more stagflationary than not.
Well, I'd say also one of the biggest differences with the 1970s is the Federal Reserve's balance sheet.
Right.
So maybe we should talk about that a little bit.
Yeah, so we're seeing this quantitative tightening situation so what the Fed has done post the global financial crisis, the big experiment was, we're going to basically buy a bunch of treasuries and mortgage-backed securities, and what that's going to do is going to lower the long-term interest rate, because if I'm buying a 10-year treasury, I'm lowering the interest rate on mass. The Fed has endless amounts of money to do so. And then also buying mortgage-backed securities is going to lower the mortgage rate, which will allow more people to buy homes, and that's going to stimulate the economy. And what we're really seeing now is this massive double whammy where the Fed is reducing the balance sheet. So as these mortgage-backed securities and treasuries mature, the Fed actually hits the delete button and wipes out almost $100 billion worth of money out of circulation monthly. But what they're doing is they are not supporting the US Treasury market and mortgage-backed market at a time where the government is spending 9% of GDP. So the government is issuing an insane amount of bonds and bills to pay for these massive deficits. And the Fed is not monetizing it. And that's causing a crash in the bond market, especially over the last few weeks.
Okay, so maybe you can expand on that a little bit more, because you're talking about how, again, we're seeing record levels of government spending. And this is kind of getting to the other side of things, which is, where's the government borrowing to facilitate that?
Right. So the government is predominantly using bills, which is the shortest term. And you can see that bill issuance has always been relatively high, but post-COVID, it absolutely exploded. And bills, because they're so short term, usually create a drag on the spending and money in the economy in the very short term, because that just creates an incentive for money to leave the economy in the short term into bills, where bonds and notes that tend to be longer duration have less of an impact. So you can see predominantly bill issuance is just exploding.
Obviously, that has to beg the question, which is how does this tie back to Treasury yields? Because if you're doing such widespread issuance, it's hard to understand such wide issuance into a hiking cycle.
I think that's a pretty unique period of time that has happened. And as a result, we are seeing the highest US Treasury yield since at least 2007 now. But it's across the curve, right? So the 2-year yield is in the fives. The US 10-year Treasury is at about 4.5%. And it's just hard to believe that we're able to sustain these type of rates and this amount of debt. But again, a lot of it has to do with the fact that so much debt was fixed rates across corporations and companies. And they say monetary policy always works in a lag, because you need to allow enough time for all these refinancing cycles to come in and for people to really feel the tightness of credit and how expensive it is. And it's starting to bite now. And this is why it's so, people fall for that soft landing narrative every single cycle, because they're saying, well, rates are up and everything is fine. I was like, of course it's fine. It's because you didn't have the time to refinance into all these higher debts. And now we're in a situation where I think the economy is incredibly susceptible to that.
Well, we can't talk about Treasury yields without talking about the yield curve. What's the latest that you're seeing in terms of
the yield curve inversion is starting to steepen, and it's usually when the disinversion happens. So the steepening starts, so you go into a deep inversion and then you start to disinvert. That's usually when you fall into a recession. You can see 2006-07, we had the deep part of the curve, and then we come back out, similar in 2000. But this has now been one of the deepest and longest inversions in history, at least going back to the 70s. And historically speaking, the longer and the deeper the inversion, usually the longer the recession. And the worst part of it all is that when you get the steepening with weaker growth, that's when recessions get pretty bad. And we're starting to see that now as nominal GDP is starting to trend down. And we've talked about the GDI versus GDP. So as we're seeing that GDI leading GDP, we have an idea that GDP is likely going to fall back down. And usually when we go past the zero line, the things really accelerate. So we're pretty far away from the zero line. But what I want to bring up is that the latest part of this inversion that we've seen over the last few months. So in April, in March, when Silicon Valley Bank was happening, we primarily saw an inversion coming from the 2-year. So that was an expectation the Fed would lower interest rates in response to the small bank crisis. But now we're actually seeing it from the long end, and that worries me substantially more. So, there's two ways in which it can happen. You're looking at the spread between the 2-year bonds and the 10-year bonds. So let's say the 2-year bonds are at 5.5, just like here, and the 10-year bonds are at 4.5, right? So that's a 1% spread. And usually the inversion can happen in two ways. The 2 can either fall or the 10 will rise, right? So in March, we've seen the 2 fall and the 10 was falling, but not as much. But now what we're seeing is the 30-year and the 10-year are rising very quickly, and the 2-year is rising slowly. That creates massive tightening on the economy because so much debt is actually tied to the long end, mortgages, mortgage-backed securities, and so much transaction in longer-term debt. And that's starting to hurt the banking system, and that's starting to hurt lending quite a bit. And historically speaking, when we see the bear steepening, that was when things were most likely to tighten significantly.
And is that what we're seeing right now?
Correct. So the latest move from negative 100 basis points to negative 60 basis points in the yield curve was all led by the long end. And primarily because the market capitulated on the Fed higher for longer, they're starting to believe the Fed, which is very interesting because when that happens, they're selling off the long end, and that usually leads to the end of the tightening cycle because then the economy just contracts and the Fed has no choice but to lower rates.
So given the nature of this steepening curve, does it lead you to believe that a credit crisis is more or less likely? Does this type of steepening have an influence there?
Yes, I think that it makes a credit crisis substantially more likely. I think we're going to see an additional banking crisis that may be on a order of magnitude bigger than what we saw in March with Silicon Valley Bank, order of magnitude. But it's probably going to be in 2024.
Got it. So maybe then you can explain, and if we're seeing all these negative signals in the yield curve, and we're seeing the bear steepen, what are you seeing then with regards to real yields and forward PE ratios? Because things still seem pretty rosy there.
Yeah, so generative AI is a big part of this. But again, there is a very strong correlation between the real yield and the valuation you're willing to pay. So when you're looking at the forward P, and by the way, forward P is typically pretty rosy as it is because that's analyst projection of what the multiples are going to look like. And you can see that historically there's just a very strong correlation between the two, right? Because if real yields are negative, it's okay to have a money-losing business because growth is all that matters in a low interest rate environment. But when you're able to get 5% for your money and you don't need to take as much risk, valuations just tend to be substantially lower. Historically speaking, that's always been the case. And we're still seeing one of the bigger divergences between the real yield and what the forward P on the S&P 500 is. It's the entire S&P 500.
So that would seem to imply then that valuations are still pretty rich.
Incredibly rich, right? So valuations should be trading around 16, where they're closer to 20 today. So that still implies, 25% lower S&P 500.
Got it. So a large correction potentially to bring those two markets into alignment. Well, so then I feel like we already know the answer. We've discussed in the past, but what's driving and what's supporting the equity gains so far?
So this year, despite actually peaking in late July, and the market has lost, I believe, about 40% of its gains for the year over the last 6 weeks or so, it's still primarily driven by the NASDAQ, the technology company. The NASDAQ is still up about 40% for the year. What's interesting is that the Dow Jones and the Russell 2000s that don't have generative AI are much more reflecting of the economic environment, and they're pretty much flat for the year, or just about, where the S&P is somewhere in between because it does have more technology exposure. So Again, the difference again from the dot-com though is that these companies are actually making money hand over fist, these giant conglomerates. But we're in a situation that over 30% of the S&P is just these 7 names, and you do have massive concentration risk. So when you buy the S&P, you're really buying 7 companies for the most part, with some others sprinkled there. But you can see the Mag 7 versus the Nasdaq versus the S&P. It's quite interesting where the valuation of the Mag 7 now is still between 40 and 45 in the PE ratio versus the broader stock market is just under 20. So these companies are justifying 2.5x the valuation of the broader stock market.
Got it. So it's either we've all just agreed that these stocks should be treated differently and are different and kind of fly above a lot of these broader issues that are impacting the economy, or perhaps those valuations are a bit too rich as well.
That's right. And we'll see whether or not they can sustain this type of interest rate environment, potential recession, hard landing issues, and all these type of things. But at the same time, the market is pricing this growth of this new technology, AI, which potentially will transform the world.
Right. But I mean, they, like almost all other businesses, are subject to, consumer spending patterns. Businesses, if business bankruptcies or business can't afford to spend, whether they're selling them software or services, it seems like eventually that has to hit the Magnificent Seven as well.
We shall see.
Right, time will tell. Okay, so then one of the last factors that you always talk about when you talk about the 1970s, it's like it won't be complete without talking about energy. So where do you see either similarities or differences between where we are now with the 1970s in terms of energy?
So a ton of the 1970s stagflationary era was actually brought about by the by crude prices and energy prices, as that's been a recurring theme. Supply side shortages and OPEC really creating a boycott of the West. These famous pictures of people lining up for the gas stations, creating blocks and blocks to go in and get gas. One of the lessons from the 1973 OPEC boycott was for the United States to create the so-called Strategic Petroleum Reserve, which is this idea that the US should be independent and have massive amounts of oil in reserve. In the event that things get bad, we can tap onto these reserves and use them. And what you're seeing here in the top is the US Strategic Petroleum Reserve in red, and that's compared with the price of crude oil, both Brent and WTI, very similar. And that interesting spike in COVID where oil went negative, that's a day I'll never forget. And what you're seeing here is that the Strategic Petroleum Reserve is the lowest it's ever been. So post the Russian invasion of Ukraine and the spike in oil prices we've seen, there's been a decision to drain the Strategic Petroleum Reserve with this acknowledgement that they'll refill it at some point in the future. That was able to drop oil prices. So oil prices peaked around $120, $30 a barrel and then went all the way down towards 70. But now they're climbing back up around $90. They were close to 100 a few days ago. And one of the issues is that the strategic reserve is very, very low, and it's unlikely to be used again unless they're willing to drain it completely, as they've drained about half of it, if not a little bit more. And I think that's a major problem. Oil in general is having a variety of issues, with Saudis and Russians agreeing to cut production together in order to put more pressure on the West. And at the same time, there has been a lack of investment in crude oil over the recent years due to ESG mandates. And I think it's one of these perfect storms that could translate into not just the Fed higher for longer, but oil higher for longer, causing to some consistent inflation. But again, energy and oil is very volatile. That doesn't mean oil can't go back to $75 or $80, but in the long run, these supply issues do matter for the price of oil.
Yeah, and it really brings into question, calling it the strategic reserves. It's like, what strategy is it serving? This isn't wartime that we're drawing it down during, and what strategy do you think it's in service of?
Yeah, that's that's one of those things. The era of fiscal excess and some of the uses of the of U.S. strategic assets. It's one of those things that, and by the way, I do feel it's bipartisan, that both parties have in recent years both use strategic assets as well as fiscal, no fiscal constraint in general, and we're basically paying the price for that now.
Right. So I guess finishing the comparison after this walkthrough, how do you sum up the parallels you're seeing now between the 1970s?
Right. So I wouldn't
and the
necessarily call it
2020s?
hyperinflation, but there definitely a period of high inflation where inflation reached 12%, 74. But then by 1979, it jumped again. So one of the things that is consistent with inflationary waves is that they do come in waves, right? So it's usually not a one and done. You usually get a jump in inflation, it recedes, but then it troughs and then it comes back again. And we're starting to see that potential. I hope it doesn't turn out to be that way. Energy issues, we're seeing that oil, we're seeing production cuts, we're seeing deglobalization that's causing more supply issues in the energy market. We're getting very volatile price action. If you look at all the period from 2019 to 2020 and to today, we're seeing incredibly volatile stock market in the 1970s. In fact, between 1968 and 1982, the stock market was just flat. So you're talking about an almost 15-year time frame where just nothing happened but an insane amount of volatility. So post-COVID, big drop, huge run up in 2021 and 2020, 25% decline in 2022, comeback in 2023, and we'll see how it ends and how 2024 performs. But I am suspecting that the entire decade is going to be very volatile. And now we're starting to see the strikes, which are very similar to the 1970s. So again, history doesn't repeat itself, but when these economic conditions do rhyme, we're seeing a lot of things that are similar.
Scary parallels, to say the least. And I can understand why, the view in terms of the calm before the storm makes sense if history is any indication about what this decade might look like. So I know you had asked for maybe one extra thing towards the end of the presentation. What do you got in store for us from the trading view?
So we talked about some of the big macro, and now I'm going to tell you in the short term, it may not matter. This year, we have seen a run up in the market that has been very, very defined. This chart was from yesterday, but today we actually broke down below that green line and fell about 1.5% in the S&P, but nonetheless, it could be a temporary breakdown. We'll see how the week kind of ends. We've seen a correction from 4,600 to roughly 4,300 on the S&P 500, actually 4,275 today. September does tend to be somewhat weaker. And a lot of times what we see is that fund managers and others try to run up the market into the last quarter. And on an up year, it's very, very common as they're trying to kind of clip bonuses and things like that. And a lot of time the market does ignore the fundamentals for longer. If you believe the Mag 7 are going to continue to drive performance this year, it's not impossible for the market to try to clip the 2022 highs at 4,800 before all the impact of that macro finally drags it down. We've seen it before. We've seen it in 2000, where the market ignored it for longer into March 2000, broke 25%, and then came back in September almost to the same high for rolling over again. 2007, we've seen a big correction in February, and then the market came back in October and then peaked out again into 2008. So, don't necessarily take this as a market is going down right here, right now situation, as on the trading view, we are actually at a pretty pivotal point whether the 2023 uptrend is going to sustain or we're actually going to go higher before that happens. So just an interesting insight there, how the short term and long term are different. And then what I found is one of the most interesting charts out there is the US 10-year Treasury yield is higher than that of the Greek government.